Okay, continuing where we left off last week, talking about the top 20 investing mistakes. Let's round out the rest of the list. Let's jump into it today.
Welcome to the Financial Pathway Podcast. We're here to help you go to the next level in your finances with practical advice from speaker and financial planner Nate Skelly.
Number 9, not reviewing regularly. A lot of people I meet just haven't looked at their investments in a long time. You know, life's busy, got a lot of things going on. Maybe money's not really your thing, or maybe you get statements and you just don't understand what they are or what you're looking at. So I understand that, and I certainly, like we've talked about already, you don't want to be constantly like tweaking and tinkering. Like you don't want to be over analyzing, being so short term and constantly trading. We don't want to do that, but you also don't want to be going really long stretches without updating either, or at least being aware and reviewing. So what are we talking about? Like what kind of things would we need to review? Well, things like your risk level, over time, how your money is invested should usually become more conservative over time. So maybe you started investing when you were 35, but now you're 50. And probably the risk level is going to be a little bit different. So that may need to be addressed and changed. Rebalancing. Sometimes you set up a portfolio and you've got the percentages. We're going to have this percentage in stocks, or this much in large U.S. stocks or international stocks, and this much in this types of bonds. But over time, if one is done really well and another one is not done, now the percentages might be out of whack. And it might make sense to go ahead and take some off the table with the ones that have done well and reinvest in ones that have not done as well recently, because we know over time with investments, things go through seasons. And if one investment's done really well recently, well, great. Let's go ahead and sell high there and maybe go ahead and buy low in another area of opportunity. So these types of things, if you're not reviewing regularly, you might miss out on those opportunities, and your investment strategy might start getting out of line with where it needs to be. Number 10, misunderstanding risk. Almost everyone understands the risk of being too aggressive. There's a difference, between investing and speculating. We don't want to get so aggressive that now we're basically gambling. We're just kind of throwing darts at the board and really hoping, hey, let's. I've never heard of this cryptocurrency, but maybe it's going to really take off. I heard from so and so that it's about to. Right? We don't want to be too aggressive. But I would say when it comes to misunderstanding risk, usually it's in the other direction. Yeah, some people are too aggressive and go way too far, and they're not investing anymore, they're speculating. But on the other side, people often forget there's an equal risk of being too conservative. It's dangerous to drive 110 miles an hour on the highway, but it's also just as dangerous to drive 30 miles an hour. And what happens sometimes is people are so conservative that they don't allow their money to grow over time, and they don't get to their goals. They undershoot them because they were too cautious. So got to make sure that we find the right balance, and that's going to be different for each person. But you want to make sure that you put yourself in a place that says, okay, if I can get this return over this time period, that should set me up where I need to be. So don't go over that, but also don't go under that. Number 11, not knowing your performance. For me, this is a big reason why I regularly meet with clients and give them their performance updates, not just of like what their account did, this year, but what it's done since we started investing. Because you need to be aware of how you're doing. Just like any goal, you have to have a way of measuring the progress and seeing if you are still on track. And so sometimes people, maybe just because they don't want to be bothered by it, or they get a little bit anxious or nervous about it, or they just don't really know how to evaluate their performance, they don't know. They put money in a fund years ago and they haven't looked at it in a long time. And when they do, they see a number, but they're really not sure how to evaluate that or how to quantify that. So understanding your performance and how it's doing over time is also a very important part of that investment journey. Number 12, reacting to media. This is a tough one. It's a big one this year, especially with the presidential election and how histrionic the media can sometimes get on these things. I'll reiterate something that I've said many times on the podcast and many times in client meetings. Do not make investment decisions based on politics. Please, I beg of you, don't make investment decisions based on politics. Why? Because investing is not a political move. It's not a political decision. When you're investing, what you're deciding to do is put your money in good companies from many different industries and parts of the world and that are trustworthy to be innovative, to create goods and services that people want, and to make more money than they did before. And this works. It has worked across every political combination of Republican and Democrat. It has worked through wars, through recessions, through terrorist attacks, through disease outbreaks. It's a bet on capitalism and human ingenuity and the economic systems that are in play and supply and demand. Like, it's not about politics. It's not about who's in the White House. It's not about who just got a majority in Congress. I'm not saying that politics don't affect our economy and don't have an influence to some degree on, on even the stock market. It can, but we way overweight the influence. And I would really encourage you to be very careful about not letting media get you all worked up and hyped up to make financial decisions based off of, again, a presidential election or some type of worldwide event. There's a great chart. I usually show it to people when we start working together, when I'm explaining about investments. It just shows the stock market returns over time. Like, it's a long chart. And all throughout that chart are these little pins and arrows showing at different years and different intervals all these different crazy world events, outbreaks of wars, and just geopolitical events, and what it shows is that basically what it shows is that there's always a smart sounding reason to be concerned. But what happens through all of that? The market continues to climb, continues to do its thing, even through all the craziness that at the time people thought, oh no, what's going to happen? How is this going to change? Our world will never be the same. And yet, the market just continued to do its thing. So that's a big one. Number 13, forgetting about inflation. This goes pretty close hand in hand with the understanding risk. One, inflation is a very underrated risk. A lot of times people just don't really quantify it very well. It's hard for us to kind of understand in our minds. We understand generally the concept, but mathematically it's kind of hard to work that out in our minds. After 1 year of 4% inflation, $100 is worth $96 now. Okay, so that's not too hard to understand. Sure, it erodes by 4%. But after 20 years of 4% inflation, $100 is now worth $44. So in just 20 years' time, our money could be, the value, the purchasing power of our money could be eroded by more than 50%. That's a really scary prospect when you think about how devastating that could be to your financial plan. That's why it's so key that you have to grow your money to fight the effects of inflation. If you keep your money in a checking account or under the mattress, it's losing purchasing power every year. And most retirees these days, we're living 20, 25 years or more in retirement. Like, you've got to make that money last. You can't afford to just let that money sit and do nothing and be eroded by inflation. You got to invest wisely, got to maintain its purchasing power. Don't forget about inflation. Number 14, trying to time the market. When's the next recession? People will ask. When will we hit a bull market? When's the best time to buy stocks? Should I wait until after the election? January? Sell in May and go away? Listen, nobody knows. Nobody knows what the market's going to do next, especially the guy on CNBC who's very loud and very confident making his predictions. He doesn't know either. Invest in a solid portfolio of investments that have a strong track record of going up over time, and let it do its thing. And so many people, they get themselves in trouble by selling, and then they watch the market take off right afterwards. So they're like, oh man, really worried, 2020, COVID, what's going to happen? Let's just kind of get out. Let's see how this all plays out. And then what happens? Boom, here goes the market. Takes off. Oh, if I just kept in my investments, I'd be doing fine right now. I'd actually be better than I was when COVID started. Or they wait for a dip. Oh, recession's coming, was 2022. Everybody's saying, every expert, look at these charts, look at all the, everybody says it's coming. Let's wait for the dip. I've got money. I'm going to sit on the sidelines. Let's wait until things get a little bit worse. Well, then what happens? 2023, market does amazing. What has it done in 2024 so far? Done great. They're waiting for a dip that never came, and the markets continue to push higher, and they've lost out on a really significant gain over the last couple of years. Don't try to time the market. Number 15, not doing due diligence. Now, this one specifically in the list was talking about your advisor. So here we go. Do your due diligence on your advisor. Did you know you can check your advisor's history on BrokerCheck? I'm on there. You want to look me up? See my history? I can tell you right now, there's not really anything on there other than where I've worked and how long I've been in the industry. Every advisor, you go on BrokerCheck, or if they are a registered investment advisor, if they're a fee-only advisor, they'll be on kind of the sister site, but there'll be a link from BrokerCheck where you can get to that page. I'd encourage you, if you work with a financial advisor, just look them up. It takes 2 seconds. BrokerCheck. It shows their employment history, if they have any complaints that have been lodged against them, if there's any previous disciplinary or legal actions. Most advisors, very clean history, but sometimes you'd be surprised what comes up. Just do your due diligence on the person that you choose to work with. It's a sacred trust when it comes to managing your money and getting financial advice, and you don't want to just leave that up to anybody. So, good advice. Number 16, working with the wrong advisor. Okay, so very closely related to number 15. How do you know? How do you know who's the right advisor, wrong advisor? Well, here be a few things that I would encourage you to think about and to ask an advisor before you choose to work with them. First of all, who do they work with? What's their niche? If there's somebody that works with everybody, that's probably not a good sign. The financial planning field is so broad. Trying to work with everybody stretches you very thin. I can just tell you that when you work with an advisor that works with similar people in similar situations, they get very good at solving those unique problems, and they get better at being more efficient in solving your problems better. Understand, how do they get paid? What incentives are at play? Do they get a management fee? Are they just paid on a flat basis, an hourly? Do they get a commission if they recommend certain products? How do they get paid? What are their incentives from their company that they work for? It's good to know. What will they do for you? Are they just going to manage your money? Are they going to give you advice on other aspects of your life? Are they going to help you with tax planning or estate planning or understanding insurance or Social Security? Or, what am I getting for what I'm paying? And it's a good idea to talk to a few. Just like any important relationship that you're looking to form, a professional relationship, it's a good idea to interview a few different people. Sometimes you might talk to one person, it seems great, and then you talk to another person, you're like, oh, you didn't realize that there was even difference or alternatives until you kind of understood the landscape a little bit more. So number 16, work with the right, or number 16, the mistake is working with the wrong advisor. Make sure you're working with the right advisor. Number 17, investing with emotions. Very easy thing to do. We're emotional creatures. Nothing wrong with that, but we got to be careful to leave the emotions out of the investment decisions as much as we can. The average investor loss due to emotion-driven decisions was 3% a year. That's a significant difference. There's really two big emotions that drive our investment decisions: greed and fear. When things are doing well and markets are up and people are making money, we want more of that. And we're willing to take risks and to kind of overextend ourselves in ways that are not smart. Got to be careful about getting too greedy when things are good. But on the flip side, you got to be careful about fear. When things are bad and the economy's in a recession and we're heading into a new presidential election and the market's down, it's very easy for us to let fear take hold and to hit that panic button and say, I got to do something different. I think this time, sure, I know this happened before, but I just feel like it's different this time. I feel like we're on the verge of something and I'm just scared and I don't know what's going to happen. And usually greed and fear are the culprit for most of our bad investment decisions. So understand their role, figure that out now so that your rational self now will be able to talk your irrational self later out of a bad decision. And of course, that's part of the job of a good advisor as well, is trying to be that rational voice when our emotions tell us to do an irrational thing. Number 18, chasing yield. What we mean by this is the yield on an investment. Certain investments have like a stated interest rate or a stated yield, particularly like bonds would be the most common type of investment that would have a yield attached to it. You just have to understand this: higher yields mean higher risk. So you might see, hey, look at this bond fund. So and so told me about this bond fund. It's paying 9%. Wow, like my bank's only paying 3% on my savings. This seems great. I should put more money in this. Or, if the stock market only makes 8 to 11% and it's all the way up and down, why don't I just invest in this? It makes 9% guaranteed. Why wouldn't everybody do this? Well, it's because it's made up of what we call junk bonds. Like, that's literally the term for them, junk bonds. They have a lower credit rating, and they're more likely to default, which is why they pay more. So just like, people that have a worse credit score have to pay higher interest on their loans, right, in order to make it worthwhile for the lender, that's essentially what you're doing. When you put money in a junk bond fund, in a high yield bond fund, you're like that lender who's giving out loans to people with bad credit scores. They've got a much higher risk of defaulting, and you're just basically hoping, I'll get enough money in the interest that even if maybe a couple of them default, it won't hurt me too bad. And I've seen even more brazen examples than this. On the more extreme side of this, I've seen advertisements where they'll advertise high yield on like a cryptocurrency or a real estate fund, and it's like, oh, 15%, 18%. That should be a huge red flag. Be very, very cautious. Everything with a high yield like that is going to be a very risky investment. You need to be extremely cautious about, and don't chase yield. Okay, moving into the last two, honestly, I think these are the two best ones. And these are all been great, but I feel like they saved the best for last. Number 19, neglecting to start. The rule of 72, says divide your annual return by 72, and that will determine roughly how many years it takes for your money to double. So if you're earning 9% return on your money, it will double every 8 years. Think about what that means in terms of compounding. If you get started now, instead of 8 years from now, you would have twice as much money when you're finished. So start early. The biggest mistake that I see is people come to me, and I've had so many of those conversations. Nate, I wish I had heard somebody tell me this when I was 25. I wish I had got started when I graduated college in my first job. I wish somebody would have talked to us as a young couple and explained how compound interest works, because now we're 5 years from retirement and we're doing the best we can, but there's not too much we can do now. Get started right away. The best time to plant a tree is 20 years ago, and the second best time is today. And then number 20, last but certainly not least, number 20, not controlling what you can. The last investing mistake, I would say, is probably the most important one in this list. Such a good reminder. It's easy to feel powerless against the waves of the economy and the stock market and inflation. It feels like we're just in this little rowboat out to sea, and these waves are up and down, and what can poor little me do, because all of this is out of my control, and I don't know. The key to good investing is not worrying about the things that are outside of your control. You can't control who's going to be sitting in Washington, D.C. You can't control whether we're going into a recession. You can't control the stock market. You can't control whether another war breaks out or what inflation is going to be this year. That's all out of your control. But what can you control? Well, you can control whether or not you're saving consistently and increasing your savings. You can control whether you're paying off debt. You can control whether you're living below your means. You can control whether you're getting your full match from your employer on the 401k. There's a lot of things that you can control. And the people that I've talked to that have done well financially, very few of them lucked into their situations. Almost all of them got there because they made small, consistent actions that stacked up over time. And it's really cool because I get to sit with them and organize all those finances. And one of those things is I'll show them, as I'll say, hey, here's your net worth. Here's all your assets minus your liabilities. And very often people are very surprised with the number they see. They think, wow, yeah, I guess it's true. I can't argue with the numbers, but I never really thought that that's where we would be. I never thought that we would be millionaires. Never thought that we would have that kind of net worth to our name, because we never really thought of ourselves as wealthy. They just did small, consistent actions. They controlled what they could control. And over time, that built up to something really, really big. Well, that's the end of our list. I hope you found that helpful and interesting. Hey, before I go, check out the YouTube page if you haven't already. I've found that I've been spending more time on YouTube recently, and I think a lot of people have. And so I want this podcast to be on Spotify and Apple Podcasts and all those places, but I'm also putting these on YouTube as well. So go check it out. Give us a follow if you can, and that'd be great. Thanks for listening, and I'll see you in the next episode.